Welcome, everyone, to the Token Economics conference call. I'm Lou Kerner, a fellow crypto enthusiast and crypto investor. I'm also a partner at Flight Ventures, where I manage the Israel Founders Syndicate on AngelList, investing in great tech companies founded by Israelis wherever they live. And FYI, for anyone on the call who isn't aware, Israel is already big in crypto, and they're going to be huge. I'm excited to be hosting today's conference call with Yaniv Feldman and the Geek Time team. And Yaniv and I have had two valuing cryptocurrency calls over the last 2 months, and they were both great. They're both available on replay. And this call is a natural complement to those calls because, obviously, the value
Hello?
Okay, I think
scientists in the token economics field to be on the call with us today. And well, okay, to be honest, they're not really scientists, but they are people who have thought deeply about token economics, and some for many years, and they have a lot of wisdom to share with us on the topic today. So I'm excited to get going with the call. We're going to start with Tom Bollock from Mad Networks. We'll then hear from Mark Smargon from Colu, Ben Perper from YouNow Props, and we'll finish with Jake Bruckman from CoinFund. And after Jake talks, we're going to curate questions from the audience that are typed into the chat box on GoToWebinar. Our speakers are talking off slides that you can download from GoToWebinar as well. And this call is being recorded, and it'll be available on Medium tomorrow. And with that, I'd like to turn the call over to our first speaker, Tom Bollock. Tom?
Thanks, Lou. Great to be here. Let me show my screen. Is it showing all right? Right, so I guess one of the things I want to talk about is, you know, overall there's a bunch of different theories in token economics. So I kind of want to give like a hard example of like what we're thinking of at Mad Network. Basically what we're doing is we're building a distributed ad server at the end of the day so that publishers and advertisers can both participate with something in the middle that no one owns. To, you know, basically the idea is how can we throw value back to the publisher and advertiser? And then, you know, one of the use cases that I usually like to give is, you know, advertiser wants to spend $1 million, right? So good example here at, you know, Mad Network, advertiser wants to spend $1 million. What they do is, let's say Mad token is at 25 cents. So they're going to take essentially 4 million Mad, stake it in our system, which then produces a non-fungible, non-capped, pegged to the USD, what we're calling Mad Cred. And essentially, Mad Cred is the token you're going to use internally in the system, so that, you know, when publishers are selling spots for $10, you're actually spending 10 Mad Cred. And you know, one of the big use cases we wanted to keep to is that at the end of the day, advertisers and publishers want to use, they want at either end to be USD, and that what we need inside is this cryptographic engine that is you know, clearly handling things and you know, is fully visible to both sides. So you know, you take your 1 million Mad Cred as the advertiser, and then so publisher has a $10 slot they want to show ads in. Advertiser wants to spend all the Mad Cred on that. They spend, you know, basically 10 Mad Creds of the $10. So yeah, basically what they do is when they spend the Mad Cred on the publisher, 1 Mad Cred token is going to the miners. And we can kind of talk about the miners a little bit later, you know, as we're mostly talking about tokens right now. So move this. Publisher exchanges their 9 Mad Cred for 9 USD at their broker. So what we're saying there is that the publisher is essentially saying, hey, advertiser, send me $9 USD via Bankwire, and I'll return my MAD cred to the smart contract that created it, where the original MAD tokens were staked, and what that does is it'll burn the MAD cred essentially right then. Now that, you know, as you can see here, the spot is paid for, and the MAD token is re-released back to the advertiser. Now, one of the important things we also did is that when you originally staked your MAD token, we burned 1% of it. You know, the idea is that over time is like you want the MAD, because remember, as the miner is getting paid in MAD token, the publisher is getting paid in USD, so we kind of want to maintain the value of the MAD token for the miner, and that's kind of how you achieve that. Because, you know, there should always be some sort of burning mechanism in an economy. You know, even Vitalik has said that.
And I'm sorry, what's achieved by the burning?
Is you basically are raising the value of MAD, the MAD token over time. So remember, the advertiser came in, they staked $1 million, and then you have MAD token, which is free floating out there. So the idea is that by the time the MAD token gets to the miner, we want to maintain that value somehow. And you can kind of achieve that with a burning mechanism. And
so the burning mechanism is kind of a built-in inflation rate to some degree?
Yes, yes. You know, kind of like gases and ether. You know, have a slight burning. And then another big thing we have is that when the advertiser, so MAD cred went back to the smart contract where the staking originally happened. When that is returned, that smart contract then produces a bonus token for the advertiser. And just to stop Sybil attacks, what we do is you have to be a member of AdLedger, which is kind of the nonprofit consortium we formed for ad tech and blockchain. So as long as you're a member of that, you receive bonus tokens. And the role of the bonus tokens, which eventually go to 0 over time, but in the beginning, what you do is you use bonus tokens in place of the MAD token for staking. So, you know, the idea is that if you're gonna, like, if you've been using this over time and you're going to stake $1 million worth of MAD token, if you have 500,000 in MAD bonus, you can use that in place of MAD token. So basically, what we're acknowledging is that there is some risk takers or agents that are going to assume risk because of a free floating token. And we incentivize them to take this risk by usually giving them some sort of bonus. And I think that is it. Yes. So it's a little complicated.
Yeah, that's actually my question.
Yeah.
So you've got 3 different tokens,
Yes.
kind of, you know, all working away.
Right.
When you talked to the different players in the ecosystem, be they the advertisers or the publishers,
Right.
what kind of feedback have you gotten when you talk about kind of a 3-token world?
They actually really liked it, especially with the fact that you're taking essentially. So everyone that we've talked to is like, look, at the end of the day, I want to get USD. How do I do that in this? It was like, well, that's interesting because essentially our system internally works as a system of credit, right? Which in today's world, that's exactly how EdTech works. It's all a system of credit, actually. In fact, a lot of these players, like some of the biggest advertisers in the world, they have repeatedly said that any ad tech system that requires them to pay up front for advertising will not work, and we will not use it. And this is from the absolute largest advertisers in the world. So, you know, that's why with a system like this, where you're actually just staking tokens that either you hold or some broker who's taken that risk for you, because basically they're holding that commodity, which they are just using as a gate into the system. If you think about it, so think of like a drink ticket system at a carnival, right? So you go in, you give some money to the drink ticket holder, which would be, you know, quote unquote mad token, and then you're sitting there spending these drink tickets within the carnival. And there could be many actors in the carnival, right? Who then later go and get their USD by returning those drink tickets.
Okay. You know, and I know you've got a tremendous background in terms of your time spent at Zynga, you know, developing a lot of their token economies. So I appreciate your coming at this with, you know, probably more experience than most other people in the ecosystem. When does it actually launch?
We're doing our token sale now. That'll fully launch November 30th. We're hoping to have a system in place actually next year that's actually using the token, and people are advertising using that.
Okay, well, terrific. Well, thanks a lot, and I'm sure we'll come back to you, Tom, and you know, during the Q&A. And next, pass it over to Mark Smargon from Colu. Mark.
Hey. Okay. Can you see my screen?
Yes.
Okay, so hi everybody. I'm Mark Smargon from Colu, in charge of the blockchain in the company. I'll give you a quick recap of what we did and where we're standing right now. Colu today is a company that is active for the last 3 years. We started as a developer platform in the beginning, and last year we decided that basically we said that our biggest advantage is the consumer. Our biggest strength is really providing consumer products, and we try to understand the needs of the developers, the shape of the protocol, try to understand the value of this technology. And what we came up after we saw a huge demand for local currency issuance is a local currency app that we launched last year. So the app is mainly a digital wallet. It's not intended to be a niche product, so it's not focused on holding Bitcoins or holding Ethereum, not targeting the crypto community, but really we try to focus on mainstream audience, understand what are the banking needs, what are the problems, and really try to understand a little bit about the problem side, not the solution side. The local currencies were issued in 4 economies. In Tel Aviv, which was the first, in Jaffa, which is also in Haifa, which is also a city in Israel, Liverpool, and East London. Those 4 communities are currently thriving. We really started by really going to businesses, trying to onboard the businesses directly, not waiting for a bank or a municipality, just start really building it from the ground up. Today we have about almost 100,000 users. This is the graph of businesses that are accepting the currency. So the idea was really simple: to reduce the learning curve for consumers, just give them an app they can pay in the most easiest way possible without any learning curve. You can just pull out your app and start paying, and really it was intended to be, the goal was to build the closest digital equivalent of physical cash. So the app was intended to be super easy to use and fun. We started to see really nice numbers in terms of monthly transactions. We tried to apply, like our mantra was to look at what worked with Bitcoin, which is economic incentives, try to see how to apply them in those communities, and it really worked out well. We see very nice traction in the recent months, especially since this app is really new. One of the interesting things we saw is that really retention is really higher than existing payment systems. So the retention for our app is rising on a regular basis. We see 20% of depositors that are still active after depositing the money. So we have a very nice stickiness numbers in our app. And the thing with
Mark,
yeah.
Can you explain when a consumer
buys the Colu, what it is exactly that they're getting, and what the incentive for the consumer is?
Yeah, so Colu provides an incentive to the money. So right now the onboarding experience is really unique. We basically give you a small sum of about 10 pounds, if I remember correctly, for new users, and the onboarding experience is really go downstairs and buy something. The idea was to onboard all the businesses in the local area, make it really useful, make it really fun to discover new businesses in the area. The idea for the businesses, the value proposition for businesses is really that it's reducing their costs, reducing their fees, bypassing Visa, bypassing the banks, and really provides them a frictionless environment. They can move money around. Right now we're giving a small bonus where you, when you're topping up the account, but I think that the major stickiness factor is the fact that users can do money in using their credit card, kind of topping up their account. But the only way to do money out is actually spending it physically in businesses. So you have to be a local, and you need to spend it at local businesses. And this really worked well for us. It was really interesting to see how people react, especially with the incentive, but also from the perspective of helping the community and the businesses in the community, working only with small businesses, not big chains, keeping more money circulating inside a closed money system. So that's basically the model. One of the biggest things we try to figure out is how to add cryptocurrency to that, how to make the transition or create a bridge between mainstream audience and this technology, and how to create a sustainable model where we can incentivize people to spend and keeping it really friendly. So we came up with a unique cryptocurrency model. We're basically announcing an ICO, a token issuance event that platform for local currency. So each local community can create its own local currency on our platform, and this local currency is basically pegged to local consumption. The idea is to make the ecosystem to facilitate fiat transaction in the ecosystem, and the percentage that once went into Visa or other payment systems as fees will go into that. So the first and foremost objective of issuing our own token, which is called the CLN, is to incentivize new gateways. So up until now, Colu was basically the entire value chain. Colu was the gateway, Colu was the custodian. We want, first and foremost, to decentralize that. We want to incentivize new gateways to act as custodians of funds and accept fiat deposits for customers and reward them with the CLN for purchases they're making. But also the CLN will allow them to access all the services on the network. So CLN is kind of an underlying payment platform that allows issuers, community managers, credit unions issue their own local currency, which is basically allowing them to launch their own payment network, a very local payment network. And it's basically what we tried to achieve all along, which is a replicable model for creating a local currency. Local currencies are today very popular, but they're not successful on a big scale. They're very local. We try to find a digital way to make it replicable.
And Mark, when a
business gets
the Colu or gets the local currency, what is it that they do with it?
So we have a business app and we have a consumer app. The consumer app allows the customers to top up their account with regular fiat, with shekels or pounds, depending on where you are. And the businesses have a special app that allows them to withdraw the money to their bank account, whether it's automatically. They can see how much people saw their listings on the app. They can promote themselves through the app. They can get analytics. In the future, we want to provide them really with information and access to those digital payment systems, give them advanced capabilities like tell me how much people bought at my store in the last year more than twice. Like I want to send them a special discount. So those capabilities will be through the business app, which is already operational. We have about 1,000 businesses that accept the coin. By the way, if you're in Tel Aviv, you can actually like go and live on Colu pretty much for everything you need, from your laundry to food to pubs and restaurants. So
when the consumer goes from fiat to Colu, what kind of bonus do they get?
Right now it's 10%.
Terrific.
Yeah. Okay, so the CLN allows us to scale the network, creating an incentive for gateways to act as custodians. And then after we have the custodians, we have the different local currencies. Basically, we use the CLN for liquidity. We allow to move between local currencies. One of the biggest challenges of imagining a system like that up until a year ago was the fact that we need to facilitate all those transactions. It needs to be 100% centralized. We have liquidity problems for small communities. We have a chicken and egg problem, the fact that you can't really provide those services for a token that has no volume or not enough volume. So you have really a liquidity problem that is solved using the CLN. So we can not only solve the chicken and egg problem, we can provide liquidity or an initial value for tokens in the beginning. We can incentivize local administrators, local credit unions, community banks, incentivize them to act as custodians of this local currency. Basically, it's a new way to engage them and to partner with them, a way that we didn't have had before. And we've really been approached by people from more than 100 different countries regarding bringing Colu to their community. And this model really allows us to incentivize them very, very differently. Basically, they're a stakeholder in the token, we're a stakeholder in the token. This really aligns our interests. Another thing that was really important for us is the fact that you need to be able to move between communities. So if I want to move funds in a local currency between Israel and UK, up until today we couldn't do it, but today you can do it with the CLN no matter what's the liquidity of the token. So the CLN allows us to provide liquidity for the tokens, provide us with price discovery capabilities, and that really solves a huge pain and allows us to imagine this architecture. So another aspect of the token, which is probably the most important, is the proof of receipt mechanism. The idea is to create a system that really pegs the value of the token to actual consumption. The idea is to take a fee out of the dollar value of the purchase and convert it to local currency in real time, and basically facilitate this exchange on the fly while people are buying behind the scenes. So I can not only use the merchant terminals as a distribution mechanism for the local currency, the more people, I basically convert the merchant and the consumer with each purchase that is doing to a token holder. This is also a very good way to pay fees to the network. And in the future, I believe it will also be a very good way for a government to regulate those local currencies. So basically, we have a transaction here. We have a tax event. We can not only streamline bookkeeping and really embed the hash of the transaction, of the invoice, the receipt, verify that it's a valid transaction, give the reward, make the exchange. We can even visualize in the future a possibility where a government can actually accept tax or VAT tax payment on the fly using this mechanism. So it really can not only give more tools to a regulator in terms of adding more custodians without adding custodial risk, but also it can really increase the taxation base for governments. So this is really something we think that the government can embrace.
That's great.
Any threat.
Yeah, Mark, and just a last question. So
yeah.
when we'll go on to Ben, but when the merchant gets the Colu, and they can either spend it at another business or they can convert it into fiat, what do they convert it into fiat at?
From the moment we're issuing the CLN, the users will not interact with CLN in any way. It will be a utility token behind the scenes that facilitates the transactions. They will interact with the local currency. And the reason, by the way, we called it a local currency is because its value is fluctuating. But we didn't want to call it points or rewards or cashback or rebates. We really want people to find uses for it, even if they consider it as a speculative investment vehicle. We're not scared that we will learn how people will use it, and the local currencies are basically a system that allows fiat transactions on top of the platform. So we don't want to change people's behavior. They will still spend dollars at shops, but from this point on, instead of getting dollars as a reward, they will get the local currency as a reward, depending on their spending.
Okay, no, that makes a lot of sense. So thanks a lot, Mark. And now sure. We'll turn it over to Ben with Props YouNow. Ben? All right, there we go. Ben? Unmute your microphone.
There we go. Can you hear me now?
We can hear you now.
Perfect. Great. All right. So yeah, I'm here to talk about the Props, which is a decentralized ecosystem of video applications project by YouNow. And so more specifically, when we want to take a look at obviously the token economics behind it and the first app we're going to launch in support of the ecosystem, which is called Rise. So before we get into that, I think it's going to be helpful to go into a little bit of YouNow's background. The company was founded in 2011 and really introduced this two-sided marketplace of live streaming into the U.S. And this model is unique in the sense that it's not advertising-based digital media, but actually user-pay driven. So for those who are not familiar with the platform, it has 40 million users and thousands of influencers and broadcasters. And when these broadcasters go live, they entertain, they bring fans and viewers in. These fans and viewers are able to purchase an in-app currency, not a cryptocurrency, but more of a gameplay currency. And they can use this gameplay currency, which you can see the purchase packages on the right, to send digital gifts to their favorite performers. And this economy, this user pay is really driven by three main areas, which is attention. So I can get a shout out from my favorite YouTube star, makes me very happy, or perhaps it's patronage, where me sending gifts and likes to a performer helps them trend, helps them gain more fans, helps them gain more viewers, and ultimately more money. So you're really supporting that person's fame and their career. And then third, which is very powerful, is status. A lot of people pay to get specific badges or specific places on leaderboards, and we have all kinds of layers where people can make a name for themselves within the app, and this also drives user pay. And so, YouNow has been able to, through optimizing this gameplay and then optimizing these in-app purchases, grow revenue to about over 20 million per year run rate. and been able to do this really even as our user growth has plateaued. So what's next for YouNow, and what exactly is the Props project? Well, we think the world needs a decentralized digital media ecosystem for two main reasons. One, currently a few companies can censor, curate, and can basically just control the world's information, which long term is probably not healthy. And the second point is that value is disproportionately distributed between the network operators and the people who've actually built and contributed to these networks. So if you look at digital media today, network operators generate hundreds of billions of dollars in enterprise value, while the users receive a tiny, tiny fraction of this financial utility. In the props ecosystem, all the actors and all the users, creators, content owners, etc., have a financial utility, and they'll have a personal stake in this ecosystem, which we think is really powerful for network effects and for stickiness. And so, how do we kind of jumpstart this this new ecosystem? Well, the first app we're going to launch is called Rise, and it'll be the first props-powered app. And there's a lot of exciting new features in Rise. There's many-to-many video technology. Everyone in the audience is live. You can watch together. You can send gifts to anybody. But really, if we focus on the key economic differences, it's the creators, developers, and network contributors are all rewarded in props. So as opposed to on YouNow, where they would earn US dollars when someone bought gifts in their broadcast, here they would earn props. And twos, everyone earns. So the entire long tail is included. You don't have to be a broadcaster. You don't have to be a creator. If anybody sends you a like in the audience or anywhere in the app, you can also earn props. So how does this actually drive demand for the token and for the ecosystem in general? So for us, it was very important that mainstream users can enjoy the app and create demand for props without actually fully, being crypto educated, right? The masses out there, especially our users, who might not be all that familiar with crypto, and we don't want that to be a barrier for them to enjoy the app and drive demand. So in this world, the experience of a viewer and that kind of gameplay is quite similar in the sense that I can use my fiat money for in-app purchases, for these virtual, in-app game currency, not the cryptocurrency, and use this to send virtual goods and gifts inside the app. So, and then you now can take these proceeds from these in-app purchases, go to the market and buy props, add it to the reward pool, which is then distributed to all the contributors of the network. So in essence, these mainstream users who don't really grok cryptocurrencies can still drive demand for it as we go to the market and purchase props from the market. And so once you have props in the app, well, what can you do with it? Well, first, the most important utility is you can hold it in the app for critical gameplay and features. So as I mentioned earlier, it's very important if you're a creator to be at the top of the home page, and for that you want a strong trending score, and your prop balance will be a key contributor to this score. Like power, so your likes will be essentially worth more, maybe in the same veins of esteem, so you can be more of an influencer and a curator on the platform. We can make exclusive features and content based on your props holdings, and of course there's status all around the app that we've already showed people are spending lots of money every year for. In addition to that, you can take these props and convert them back into the gameplay currency. So if you want to take these props, convert them back into coins to send gifts. And three, of course, you can use it as a form of compensation, which a lot of our influencers will use a portion of. So as we try to understand, perhaps the value of a prop, or the utility value, I should specifically say, of the prop, we've been talking to a lot of very smart folks out there, looking at a lot of different models, and we kind of, if we looked at the CRISPR-Niski model, also talking with Alex Felix, who's a partner at CoinFund, and we can view Rise through this equation of exchange, whereas MV equals PQ, and the idea here is that as you drive demand, which is PQ, and you reduce or restrict the supply of velocity and of the token float, the utility value would appreciate, right? So the idea here is that PQ in our case is demands and props generated by the gameplay and engagement. And so how can we kind of model that and understand how we can grow this? Well, you can look at digital video watch time in the market, the entire size of the market, how it's growing, what portion of that market we think we can capture, and using YouNow data, how well do we think we can rev those hours of watch time, right? If you look at the inputs of the token utility float, this of course will be determined by token distribution event vesting schedule, the reward pool distribution, which is essentially some form of inflation, and of course then the percentage of props held outside of this float as sitting balances inside the application or elsewhere. And we can kind of think about this looking at YouNow data as comps of what percent of our broadcasters or users are receiving dollars or bars in YouNow, and how many of them are then investing them back into the platform to spend on other people, what percent of them care a great deal about status, et cetera. So we can kind of quantify roughly what that percentage is. And then finally, velocity, in our case, this is a bit trickier to kind of define. We believe in our case it kind of applies to the portion of props that are exchanged back into coins to be used for gameplay gifts. So this also, though, inadvertently, well, not inadvertently, but by design, also reduces the token utility float, as these tokens are now taken and converted into coins and removed from the float. So as a product team, designing these apps and designing these features, to kind of recap, our goal is to drive watch time and drive PQ, drive watch time hours through great content and intelligent gameplay, and at the same time restrict supply by incentivizing people to hold it in the app. And then we think we'll have a healthy token.
And so as you were talking about, Ben, the idea of when you say restrict, what you're trying to do is incentivize the streamers, the entertainers, whatever they're doing, to hold instead of turn it back into fiat,
right?
Because by holding, they'll drive more revenue in the future because they'll be show up higher in search or benefit in other ways.
Exactly. The value for them holding is going to it's an investment essentially in themselves on the platform to then increase their viewership, increase their fans, increase their fame, and increase their future earning potential, right? So we see a lot of influencers today who care a great deal about their fanships and reach, and also translating that into brand deals, into other things. It's not just on platform, but they'll have a vested interest in their future earnings determined by how many props are holding.
And how much time have you spent actually talking to these, the performers, and getting them to kind of understand how the system works? And
yeah, so I mean, it's great that we have a head start. We're not building this community from scratch, right? So we have relationships with thousands of influencers today who have signed contracts and agreements with us that are earning in USD, and we have we have teams of partner managers and account managers here that maintain these relationships. And so we've been introducing this concept to them slowly. We've been essentially rolling out alphas to them, and they're really excited. There is a learning curve, but because we have these relationships and these built, we think we should be okay.
Okay, well, terrific, Ben. And just, for everybody listening to the call, we've been getting a lot of questions, and we appreciate that. And I can tell at the moment we're actually running a little long. And so we're not going to have a lot of time for questions, but what we will do is we'll ask all of the speakers, we'll forward them all the questions that we have, and the questions that that they answer, we will we'll post up on Medium. So just because we're probably going to run out of time before we answer too many questions, my guess is there's still going to be a lot of questions that will get answered in a follow-up Medium post. In any case, thanks, Ben. And last but not least is Jake Bruckman with CoinFund. Jake?
Thank you, Lou. Just pulling this up on my screen. Can you guys see the presentation okay?
Yep.
All right, great. So hi, everybody. Thank you for having me. My name is Jake Bruckman, co-founder at CoinFund. So just as a quick background, CoinFund is one of the first crypto funds. We've been around investing in this space since 2015. And more recently, we've been working as a crypto economics advisory team and studying these different systems around tokens. This year, we've been lead advisors on Kick, as well as Ben's project, YouNow, and Props, and a couple of others. We've also done a bunch of research in sort of lower touch engagements with different companies in the space. Particularly of interest was storage, which was one of the very, very few companies to migrate from one decentralized network to another, and also to hold a secondary sale while they already had a liquid asset on the market. So to jump into token economics, I just wanted to cover maybe like 3 perspectives of at least how we've used it, and I'll draw upon a particular example across these perspectives. So digital asset pricing, right? In order to apply appropriate valuation methods for tokens, you really need to understand how the tokens work. And the interesting thing about assets on the blockchain is that they have a very wide design space and can be designed in many different ways. Economic incentives analysis is a very important area, both when you're designing the protocol level, but also when you're designing the business level. There could actually be bugs in these economic systems called economic vulnerabilities. And as an example, if you Google Yench radiation, it was a vulnerability that our community discovered in the DAO when it was around, which basically created this economic pressure for speculative traders, for arbitrageurs to just siphon all of the funds out of the DAO very slowly. Also recently, mechanism design, which is a field of economics proper, has been kind of a reference point. This field, it tries to create a mathematical framework around kind of optimizing economic outcomes and understanding the incentives of the different participants in that system. And probably the most well-known application of that is like Victory auctions and things like that. And finally, fat protocols have been a topic, and recently there's also been sort of a conversation around how does value actually flow from one layer of the functionality stack to another, and I cover a little bit of that as well. So Augur, for those of you who don't know, Augur it's one of the first projects of Ethereum. It's a decentralized prediction market platform, and this diagram sort of describes the system as it was envisioned originally in 2015 and 2016. At the center, you have this protocol which enables users to create prediction markets. In order to create one, there's a participant called the market creator who pays basically a deposit to do so, and he sets the transaction fee of that market. And then prediction traders come in and they buy shares and sell shares and do market making. And whatever turnover they create, they pay transaction fees to the market. At the end of at the expiration of the market, a third kind of participant called the reporter comes in and actually resolves the outcome of the market. So if the market was, who's going to win the presidency, Donald Trump or Hillary Clinton, these reporters are game theoretically incentivized to vote correctly, for the correct outcome in the real world. And then the market creator and the reporters share the transaction fee revenue 50-50. So that was 2016. And back in, you could look back on our blog from from that time, and there's a post there called the sane model for pricing Augur Rep tokens. So if you understand this dynamic, then you can basically intuit like a very simplistic model for getting a fair price for the token. And basically what it amounts to is that market resolving, if you forget about the part where you're doing work, pays you a periodic dividend, and that dividend is proportional to the platform's turnover. And so you could, again, very simplistically, you could create a lower bound for the fair fundamental price of rep token by considering it as kind of a present value of a perpetuity that pays a coupon. And so if you assume reasonable kind of levels of turnover, you assume a reasonable market fee, you get your coupon, which is D. And then if you also assume a reasonable discount rate, you get R, and then you have a well-known formula for pricing. Discount rates in crypto are probably pretty high. I know Chris Berniski has said it around 30 to 50%. And that's all up for debate. But at least you have a framework to think about it. However, in 2017, Augur team was doing some incentive analysis on the system, and they realized that there's actually some adverse incentives in the way that those market fees are split between the creators and the resolvers. And in particular, first of all, you have a lot of competition for like really popular markets. If it's a presidential election market, there's going to be a lot of people going over there, and so there's this competition for turnover. which incentivizes people to create markets with smaller and smaller fees. And while that's good for the traders of the market, it's actually quite bad from the standpoint that the smaller fee you have, the less resolvers are incentivized to participate and give you a correct resolution to the market. And furthermore, there's even an economic pressure to increase turnover as much as possible, because market creators can actually make more money in the system by doing a bunch of market making than, let's say, raising their fee. And so, summing that all together, you have this like strong pressure on the market fees to go to zero. And so the proposed solution from the Augur team, about 2 months ago, they described this in this year, is to bifurcate those fees into a market creator fee and also a dynamic reporting fee. And they use this concept of open interest. So open interest is basically the amount of value locked into the Augur markets at any given time. And they kind of set this target of 5 times open interest. That's what they want the market cap to be. And so if the Augur market cap is below 5 times the open interest, they will actually, the system will increase the resolver fee by a proportional fraction. And theoretically, as the fee increases, so should the market cap, because people kind of get the advantage of the resolvers working effectively, and also the perpetuity pricing should imply that the value should increase. If the market cap is above the open interest, 5 times the open interest, then the fees decrease. And so taking those two mechanisms together, you're looking at a system which tries to get the market cap of Augur to be about 5 times the open interest of Augur at any given time. And so you have a completely different formula for pricing rep in 2017, which is that you take the open interest, you multiply it by 5, and then you divide it by 11 million, which is the number of assets outstanding. And finally, thinking about protocols a little bit. So there's my most recent post was about fat protocols on the blog, and underlying that post are these 2 ideas that a lot of investors have been investing in protocols that are low in the functionality stack at the base. But I make the claim that they do not necessarily diversify exposure to blockchain better than investing in applications does. And also that investing in a protocol very low in the stack, I call it TCP/IP proximate protocols, doesn't necessarily capture the value of the functionality stack above that protocol. And Augur really demonstrates this quite well, because if you try to invest in Augur by proxy of holding Ether, then you have to do the analysis of how the transfer of value happens between the Augur protocol and Ethereum. And what you see is that holding rep gives you exposure to a function of Augur platform value, like either in the form of turnover, as we saw, or in the form of open interest. But holding Ether gives you exposure to a function of Augur's utilization. In other words, how many transactions does the Augur protocol contribute to the Ethereum layer, and also how many dollars are being paid in fees by the people utilizing it. And so the question becomes, are these exposures equivalent, or are they even correlated? And the answer is, of course not. So in the 2016 Augur model, rep prices, as we saw, they fluctuate as a function of the platform turnover. It's like a little bit of a perpetuity price. But turnover is not correlated with the number of transactions that are happening, or at least it's the correlation is pretty weak. And that's because you can have the same set of users transact either 1 million or $1 billion worth of value on the platform, but the number of transactions is going to remain the same, and their fees will remain the same. In the 2017 model of Augur, rep functions as prices as a function of the open interest. And again, open interest is not that correlated with the utilization, and it's also not that correlated with turnover. You can have a huge amount of turnover and end in a state where the open interest is 0. And to finish off, this is kind of my diagram around just demonstrating that. It's that holding Ether gives you a certain function of utilization, and holding rep gives you a completely different function of turnover or open interest. And so if you're really, really interested in kind of capturing the value of the Augur protocol, you'll probably want to hold rep. And that's about it. Thank you very much.
Okay, well, terrific, Jake. That was very, I think all of the speakers I've done, this is close to my 50th conference call. And I got to say, I really think this is the densest conference call just in terms of all four of you. Went deep, around things that are complicated to understand. And I'm sorry that we don't have more time to spend on questions. I'll start one, and then Yaniv, if you want to, you can take the next one. One of the questions that that I thought was interesting was it was to Ben, and that was somebody was wondering to the degree that you want to engage with kind of the big studios or the larger entertainers, or whether the idea of props is to more enable the long tail.
So yeah, that's a great question, and so. I think it applies to all sizes and all forms. I mean, obviously, the long tail, creators that are on YouTube or social networks and creating video is a great fit. But we're also, frankly, in talks with some large, very large companies who are interested in this new kind of future of digital media and how to play it and how they should strategically, over the next 10 years, go from more traditional media into this mobile interactive space. And so there's a lot of interest and a lot of people, talking to us about, how can they get their content into a, interactive mobile platform like ours. So I think, in the next few months, you might even see some pretty interesting announcements.
Okay, so next one is for Tom. You were talking in your presentation about the burn mechanism, and the question was, how critical is the burn mechanism to token economics? Vitalik mentioned it during DevCon 3, and what are different ways in which this can be done?
That also is a good question. Yeah, ultimately, I feel it's fairly important, especially in the beginning, especially to heavily incentivize the miners, right, to run these algorithms to mine data. I mean, as for mechanisms to do that, I mean, you could send tokens to, an address that is inaccessible, or, I mean, there's lots of ways technically to do a burn mechanism. Right now, we believe our burn mechanism is going to be activated in staking, but we might put a couple of others here and there.
The question was, in terms of, how critical is the mechanism itself to token economics?
Very. It's kind of everyone should have one. It's that critical.
Okay. Next question, which I've seen return a couple of times for almost every one of you, was, why not do the same with just use Ether or, even fiat for the same kind of thing that you're doing now? Why do you need a special token for you?
Well, for us, because ultimately what we see is the inner part of the system running is it's fairly complicated, right? So there's definitely some mechanisms that we want in our system that just doesn't exist in Ether for Ethereum. The reason why we don't want to use it in fiat is because that's the problem you have today, right? So an advertiser puts in $1 into the system, and 30 cents gets to the publisher. So you have all these black box systems all talking to one another. The idea behind this is to, bring it out into the open of what's going on.
Okay, Mark, you want to take?
Yeah, I think it's fairly easy to explain why it's better than fiat. Today's payment systems are really cumbersome, outdated, you have to have a lot of intermediaries. So this is for us a technology that allows to reduce the amount of intermediaries and really give value specifically to SMBs. Today there are almost no payment apps that are focused on small businesses, even though they're the biggest amount of they're the biggest employer pretty much all over the world. Enterprises that are smaller than 10 people have a really hard time onboarding to those payment systems. Why not use Ether? I think one of the biggest strengths of this technology is the ability to create a community around the token, to jumpstart the economy, to solve, to create a network effect. I think that the trend is more currencies. People are getting more comfortable with using different types of currencies. The fact that you can introduce new systems for machine-to-machine payments, paying with tokens for APIs, for usage. It's just a new business model allows us to really test stuff. If we find that people are holding our tokens, we can use them as a collateral for lending. We can find new use cases, things that are not so relevant if we're using Ethereum.
Okay, so we're pretty much out of time. Lou, do you want to sum up?
Sure. Look, I really want to thank Tom, Mark, Ben, Jake. You guys were all awesome. Again, I just want to repeat for anybody left on the call, you can download their slides on GoToWebinar. They'll also be up on SlideShare tomorrow, as well as a replay of the call. I know I'm going to be listening to the replay of the call so that I can better understand everything that was said, because as I said before, it was really dense. But this is an exciting field. You guys really at the cutting edge, so really thank you for spending an hour with us here and sharing your wisdom with us. And thanks everybody for joining the call.
Thanks, Lou.
Great, thanks, Lou.
Bye guys. Bye everybody.